Welcome to the Techno Fundamental Report for July 31st. Security is mostly a superstition. It does not exist in nature, nor do the children of men as a whole experience it. Avoiding danger is no safer in the long run than outright exposure. Life is either a daring adventure or nothing. Helen Keller. From the Daily Stoic, a ship in harbor is safe, but that's not why ships are built. So you got to take chances in life to ever have anything. And I wanted to point out that there's a big risk out there that some investors have, but small investors don't. And it's called liquidity risk. So in other words, if you get yourself into a position with an investment that goes bad and you can't get out of it because it lacks liquidity, that's liquidity risk. So in order to move the needle, you've got to have a concentrated or a focused position in a stock. For example, there's a mutual fund manager that I recently heard interviewed. He runs about a $2 billion fund. And when he buys a stock, he starts out with 1% of the portfolio. And his goal is to get to 5% of the portfolio. Whereas small investors like us, we start at 5% and our goal is to get to 10% because we don't have liquidity risk. That $2 billion fund has a problem if they want to get out of something and they've got a 5% position. If there's not enough liquidity in the stock, they have a problem. So most investors would be better off in an index fund. I agree with that. If you cannot do a focused approach, which means 3 out of 4 stocks are going to follow the indexes. So there's one out there that we would call an outlier. And you got to find the outlier or you're not going to outperform the S&P 500. So it would be better just to do an index fund. And we tell people if you're going to do an index fund, make it a lifetime decision, don't jump around, and do dollar cost averaging. But like Lynch says here, small investors have a big advantage, and we do because we don't have the liquidity risk that these large funds have. So when you go with a mutual fund, you're kind of putting the white flag up. Walter Deemer, price is everything. You don't buy earnings, you don't buy dividends, you don't buy management. So as we do technical analysis, we basically agree with Walter Deemer and William O'Neill. If the stock goes up, we like it. If it goes down, we don't like it. So we stick with the winners. You let your winners run. You cut your losers quick. Now, last week we talked a little bit about Jerome Powell, and this is his track record. As you can see here, inflation really started moving, and then he was late. He said it was transitory. He was late on raising interest rates or the Fed funds rate. And as a result, he was late. And so now we're kind of seeing maybe the same mistake. Inflation is coming down nicely. And, they were talking about the tariffs and it would take longer than expected and all that. But he didn't lower interest rates today. And President Trump is getting very frustrated. And so am I. He does not have a very good track record. So we need a new Fed chairman. Let's look at the market real quick. Again, this is our April 7th low. We've been in an uptrend ever since. Now remember, when the market is in an uptrend, there's a 75% chance you're going to make money in the stock market. If the market is in a downtrend, there's a 75% chance you're going to lose money. So right now we're in an uptrend, so you got to take it today and today only. Now here's the S&P 500, same thing. We made that same low on April the 7th. We've been in a very strong uptrend ever since. Don't fight the tape. The primary trend is up, so we're above the 200-day moving average, and we're in a nice uptrend here for the S&P as well as the NASDAQ. Now new highs, as you can see here. Now this is a moving average of 50. I believe that's 50-week moving average. 50 days, moving average of new highs. So you can see it's definitely turned up, and you can see here in the past when it turns up, it can be quite meaningful. So right now we're at about 25% of the S&P is making new highs. That could go a lot higher, so don't underestimate this bull market. Here's the aggression index, meaning don't be fearful here. There's fear, greed, and pride. And if you get so proud that you think you're smarter than the market, that's where you really get in trouble. So here you have the aggression index, which is comparing the NASDAQ to the consumer staples, making a new high. We've got the golden cross. This is definitely a bull market. Interest rates are steady. The power index is below zero. And you can just tell here by this graph that interest rates are staying very steady. That's what the market needs, is steady interest rates. Now here's the volatility index coming down, continues to make a downtrend here. You're down around 15.48. Now realize we got down as low as around 13 in the past, recent past, but we've also gotten as low as 12. This is very positive because when the risk index or the volatility index is dropping, it means things are more stable. Same here for the new lows on the New York Stock Exchange. We're in very solid shape here. In other words, the sellers have dried up. You can see here when the new lows pick up, market has a difficult time. But now we're in a very positive situation with this particular indicator. Also, I wanted to mention gold. You can see here gold is rolling over. Looks like it's going into somewhat of either an intermediate term downtrend, but it does look like it's putting a top here. We'll see. Now, I also wanted to point out that the brokerage firm stocks are looking pretty good. So you've got here Interactive Brokers in a very nice uptrend here. So this is bull market stuff. This is a bull market stock. So it's telling you the market's discounting a bull market. So here we have NASDAQ, which is the NASDAQ Incorporated. This is the company that owns the NASDAQ. You can see here broke out on earnings and is in a very nice, what we would call a flag pattern. That's an uptrending flag pattern. So if you have any questions, please let me know. Thank you very much.